Hey guys, hope you are having a great day so far. So since the last time we spoke, it seems the worst experienced its first real taste of what long-term inflation and economic stagnation means. We've been talking inflation for over a year now, and one of the most repeated takes I make sure to say is that high inflation is dangerous because it sets economic stability on a time clock. Though CPI and whatever other measurements of inflation matter, the real issue with inflation is that it eats into Americans' purchasing power. The longer Americans are stuck in a financial paradox where they cannot make any progress like increasing their savings or lowering their loans, the less you will see them spending money. As we know, America's economic fuel is derived from consumer spending. Without it, there is no economy whatsoever. And now, a little over a year after inflation began to increase dramatically, we are now starting to see how banks, one of the most regulated and so-called secured institutions in the entire world, are all flipping up left and right. I want you guys to riddle me this: if banks are among the first to go under, how do you think average Joes like you and me are going to hold up? That's the real question which everyone should be asking themselves. Today's video is going to be quite long, it's going to be complex, but it will answer the most important questions you all have. What exactly happened? What led to this banking collapse? What does this mean for the economy overall in the short term? Is contagion a real threat? And what does it mean for us as a whole? This video will wrestle heavily against some of the rhetoric being pushed by the current administration in the corporate media. It will have plenty of controversial takes that will be quite upsetting for many of you, but remember that everything I say is based on the facts as I see them and as I will show you. I ask that you simply keep an open mind and go easy on the comments below. Before we start, let me invite you over to my Discord, linked in the comments below. If you are a day trader or are looking to generate income on a weekly basis with little risk, we have tons of alerts being set every day to help you know what to buy. Click the link below to join one of the most consistent trading groups in the market. With that said, let's talk about America's impending economic collapse. First, let's talk about the fall of Silicon Valley Bank. The facts that came out during the last couple of days have slightly changed as the situation developed, which is why this video took me a while to publish. I wanted to make sure to have all the main points correct to relay them onto you, because remember, the fall of many of these banks happened out of nowhere and there were rumors being circulated as facts even by the media, which brought a lot of confusion for the first 2 days. Last Wednesday, Silicon Valley Bank was running well, noted as seeking to raise some funds. There were no rumors of anything going down, which kinda made things seem frantic when 48 hours later, panic broke out in the entire world when the bank collapsed. Regulators quickly shuttered Silicon Valley Bank, seizing its deposits immediately. This marked the largest US banking failure since the 2008 financial crisis, actually become the second largest ever. I have seen the media trying to downplay the fall of this bank, primarily through the rationalization that because the bank isn't JP Morgan or Goldman Sachs, its fall not that big of a deal, which is an absolute lie, as I will prove later on. The company, as information later clarified, had actually began its downward spiral late on Wednesday. As mentioned earlier, the bank announced that they needed to raise $2.25 billion to shore up its balance sheet. Immediately, a domino chain of events took place and the once highly respected bank collapsed in front of the whole world. One of the underlying themes in this event is the inability for the bank to raise money. As you guys know, we have been talking about the Fed and their actions to fight inflation for over a year now. Though they have made some progress, the Fed has still been unable to really capture any significant and permanent momentum in fixing things. Though the stock market has been unwilling to accept we are going to remain in uncharted territory for a while, the economic data is quickly mounting up and showing the cracks that are growing within the system. Because of the Fed's direct actions, and the ramifications that they carry, SVB was unable to raise money. In fact, if you look deeper, you will find plenty of stories about how startups are unable to pay their employees, how venture investors are struggling to raise funds, and the entire financial sector getting beat. Charles Schwab, one of the most reliant, prestigious and safe financial institutions in the world, has been getting slammed back to back by panic from investors. It just goes to show how quickly a situation can offset the balance of the markets, and how unstable everything is at the moment, which is something you should remember every time the media tells you things are safe. So back to Silicon Valley Bank, the main root cause of their collapse seems to stem from dislocations spurred by higher rates. They had startup clients withdrawing deposits to keep their own companies afloat this terrible economic environment. As a result, Silicon Valley Bank found itself dry on capital. As a result from this, SVB was forced into selling all of its available-for-sale bonds at a $1.8 billion loss. This sudden need for capital sparked yet another wave of deposit withdrawals on Thursday as companies removed funds, with the concern being that SVB could pose an existential threat to startups who couldn't tap their deposits. Keep in mind that this happened right after the collapse of yet another financial institution, Silvergate Bank, which helped fuel the panic frenzy. The CEO Greg Becker did not instill confidence into customers when he urged them to stay calm during an emergency call on Thursday afternoon. In fact, let's stop here for a second, because news came out just yesterday that shows CEO Becker was actually caught selling shares leading into this crisis. I am still unsure if this was planned ahead, but given the timing, it seems incredibly opportune and kind of sour to sell while simultaneously telling customers and investors that they need to place faith in your ability to keep their money safe. Going back to retelling the events as they happened, this call by the CEO did anything but instill confidence, and in fact it can be argued now looking back at how things panned out, that was actually the ultimate death blow that led to SVB to crumble down. After the call, customers withdrew a staggering $42 billion of deposits by the end of Thursday according to a California regulatory filing. By the close of business that day, SVB had a negative cash balance of nearly $1 billion, failing to scrounge enough collateral from other sources. Of course, at this point, you have former employees from SVB already making interviews or posts on social media about their own experiences and their thoughts were, which further added fuel to the fire engulfing this company. We saw prominent funds like Union Square Ventures and Coatue Management blasting emails to startups, instructing them to pull funds out of SVB on concerns of a bank run. You guys have to remember, we have talked a lot about investor psychology, and how the anticipation of any great event almost always becomes a bit of a self-fulfilling prophecy. Well, when people began to see how things were crumbling, nobody was going to be rational and hold. Everyone ran to withdraw everything they had, cementing S versus B's misfortunate demise. And that's sort of what happened. Obviously, President Biden made comments on the situation, saying he is firmly committed to holding those responsible for the collapse of SVB fully accountable. More importantly, U.S. Treasury Secretary Janet Yellen said they would not bail out the bank, which was a very welcomed addition. She also, along with Jerome Powell and FDIC Chairman Martin Greenberg, announced decisive actions that would fully protect depositors at both Silicon Valley Bank as well as Signature Bank. They said, in a statement, that depositors will have access to all of their money, citing that no losses associated with the resolution of Silicon Valley Bank would be borne by the taxpayers. The Federal Reserve announced a $25 billion bank term funding program that offers loans of up to 1 year to banks and other eligible depository institutions aimed at backstopping any liquidity issues they may face. Regulators began taking quick action to deal with the collapse. Even the Bank of London made a formal bid for the UK branch of SVB, with Elon Musk saying he would be interested in acquiring the bank, which made all Tesla shareholders roll their eyes back as they contemplated what that could possibly mean for the investment, which has been significantly affected these past couple of months by the acquisition of Twitter itself. The situation has already seen the worst it could potentially see for the Silicon Valley Bank, but the real threat and risk here no longer has to do with SVB, it has to do with Contagion. Guys, we have seen FTX, Credit Suisse, Silvergate, Signature Bank, and now Silicon Valley pretty much collapse overnight. These events haven't been slow in succession either, they were immediate shocks that left investors and customers losing in the tens of billions of dollars overnight. Anyone that tells you with a serious face that the risk for further contagion, for further collapses in the financial sector, are off the chart are clearly lying to you, and you would do very well for yourself to immediately question everything they say onwards. I mean, guys, I know it can sound hyperbolic, but don't take it from me, take it from the supposed pros on television. CNBC's Jim Cramer, notorious for his absolute trash investment takes, was urging his own audience to buy Silicon Valley Bank stock just last month. Clips began to resurface across social media showing the Mad Money host recommending viewers to buy shares of S versus B's parent company. He was quoted as listing SVB financials among his biggest winners of 2023 so far, adding that the company is a merchant bank with a deposit base that Wall Street has mistakenly been concerned with. I mean, watch the video for yourself and see just how shamelessly this guy props this company up.
The ninth best performer year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB, it's the old Silicon Valley Bank, recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year, they could come back. Yes, some of them come back here, but the stock directly reflects an oversold position. The stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. The stock's still cheap. Now, you have to remember that a stock that falls 66% like SVB Financial did last year, it takes it a lot more to recover. After losing two-thirds of your value, you need a 200% gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it. I think it's also a good example of why these bounce-back moves might be far from over. These stocks could have more room to run, especially if you think they were driven down to artificially low levels by tax loss selling, artificial dumping, like we saw.
If this guy ever endorses any company, you better reassess any investment you have in it, because his reputation is as dicey as they come. And this is only the most notorious financial television host. I cannot tell you how many articles I found from other so-called financial experts advising people to buy into this stock, reassuring investments in FTX would be always safe and the like. And these are the same individuals, along with their parasitic institutions, that are not coming to you to tell you that you should trust the financial system as it is today. That these events were anomalies and don't truly represent the safety of the banks as it should. Contagion is a real threat right now, and I for some reason believe that the current economic environment is ripe with the right characteristics to see many other banks fall. First and foremost, you have a Fed that is failing to give both consumers and institutions faith in their own ability to not just contain inflation, but bring it down to 2%. This makes investors and customers alike both weary of holding money or assets within many institutions, which could result in larger than normal withdrawals in the meantime. When the Fed and current administration are begging people to keep business as usual, because they cannot have people panicking, all the collapses are going to ensure that the opposite happens. The second thing is that a collapse like the one with SVB will have longer-term impacts beyond just the new couple of weeks. This collapse will make it harder for the next generation of startups to find what they need to build their business. Other banks will be cautious out of fear of experiencing the same problems. Another concern is that, as we have historically seen, problems at one bank help expose or even trigger more at others. An SVB executive reached by Wired magazine recently spoke in anonymity due to not being authorized to peak for the company. This person acknowledged failures at the bank, citing an institutions like SVB as integral to the tech economy, with the biggest message being for the politicians to realize that this could be a contagion if it trickles to regional banks. Startups need bank accounts and other services to secure investment from venture capitalists. New financial friction for the sector could become a brake on future tech development. Wrapping the topic of SVB, I guess the last question we have to contend with is, what does this mean for the rest of us, even if we aren't customers or invested in the company? Obviously, we will all be witness and victims to the larger effects that this collapse will have. Whether it's through regulation, or a fearful Fed that doesn't want to hike up rates anymore out of fear of what it could mean for the economy now that the banking system is showing significant cracks. Inflation is only going to remain up in the best-case scenario. There are two big components I now want to address that will demonstrate the terrible situation we are in, only to compound to you how more uncertainty coming from the banking sector will make things worse. First, let's talk about credit and debt. Please bear with me, because we are going to cover a lot here. News that car debt is piling on as Americans are forced into buying cars at prices way more than they are worth has become too common these days. The problem with high car debt is that, when wages cannot keep up with high inflation, loan delinquencies go up, and that's exactly what is happening. Experts say that because these car loans are generally unaffordable at the outset, that means that every month, borrowers are getting closer to the financial edge. For a great number of Americans, a new car loan is becoming out of reach, which is why used car demand has remained high. In fact, loans of 84 and even 96 months are becoming increasingly common, reaching levels not seen since 2006. With a record of 16% of American consumers paying at least $1,000 a month for their cars, it's no surprise that we are starting to see increasingly large number of people defaulting on their loans. The percentage of borrowers at least 60 days late on their car payment is higher today than it was during the peak of the Great Recession back in 2009, which speaks magnitudes of just how unstable this economy is. Cars aside, we have started to see household debt increase to a record $16.90 trillion from October through December last year, the largest quarterly increase in 20 years as mortgage and credit card balances surge. There are countless polls all suggesting that Americans are becoming increasingly forced to make decisions on what to pay, rent or food. If that wasn't enough, let's sprinkle in student loan debt, which is currently noted by financial analysts as crushing people's ability to pay for the basic necessities of everyday living. And let's not forget normal credit card debt being at an all-time high, which is putting households near breaking point. A recent study by WalletHub showed that more consumers are leaning on credit cards to afford increasingly expensive necessities such as food and rent. At the current rate, the study indicates that households are nearing a breaking point in which they will no longer be able to afford payments and default. Let me just stop here for an interesting take. A couple months ago, when banks had their big earnings, the financial sector saw strength in consumer spending, especially with credit. Wall Street analysts and the corporate media machine quickly made narratives to suggest that Americans are spending more than ever, that the economy is stable because the numbers suggest people are still putting money in the system. As you guys now can see, it's not because more Americans are taking trips or buying new iPhones, as shown by the poor earnings of Apple. The reason Americans are spending so much money is because inflation is making everything expensive, and the reason Americans are maxing out their cards is not because they are confident in the ability for the United States economy to survive, but out of necessity to literally make it through a month of rent and food. I'm a strong believer in freedom of expression and freedom of the press, but by all accounts, I find it incredibly disturbing how the media paints these objectively wrong and deceitful lies as facts to create a deluded society full of misinformed people. So the situation has only gotten worse with Americans' ability to pay for essential things. That was the first component of the equation. The second component has to do with the CPI results that we saw today. I do not know why I saw people celebrating the inflation report that came out today as if it is something good, because it is everything but that. The Consumer Price Index revealed headline inflation rose 0.4% over last month and 6% over the prior year in February. The media and delusional market bulls viewed this from the perspective that this was a slowdown from January's 0.5% month-over-month increase and 6.4% annual gain. The 6% jump in inflation may mark the slowest annual increase in consumer spending, but inflation still bumped up, and this slight change means nothing except that the Fed's full efforts to controlling and taming inflation are failed experiments. Core inflation, which strips out the more volatile costs of food and energy, actually ended up rising 0.5% over the prior month in February and 5.5% over last year. Now you know why the Fed does not use that number as the metric, because it's the actual important measurement and it shows that there was no real victory to be had today. The Fed seems to be more preoccupied with instilling the illusion of control than of actually doing their job right, which was something I did take note of based on Jerome Powell's last statements to Congress the other week. Stocks began surging, only to fall and then rise again. It appears market investors continue to be unapologetically optimistic about the outlook for the US economy, something that to me is absolutely laughable at the current moment given that there is no viable evidence that things have reached the worst they could get. In fact, let's actually talk about the worst case scenario, because in case you may have forgotten, the United States has a huge deadline this summer on its own debt. I keep being told by people to relax my anxiety, that the United States will come out with a last-minute saving act that will prevent us from defaulting, but I'm not buying into the hopium anymore. In the latest report, Moody's Analytics chief economist Mark Zane described the standoff over raising the debt limit as an immediate threat to the nation's economy that could negatively impact virtually all Americans. He said, and I quote, "A default would be a catastrophic blow to the already fragile economy, and the timing couldn't be worse for the economy, as even before the specter of a debt limit breach many CEOs and economists believe a recession is likely this year." Guys, let me paint it you even clearer with some basic context. Moody's Analytics is picked by Congress to give testimony on the economy. They are a very prestigious firm with an immaculate track record, which is why Congress picked them to speak on this topic. The chief economist is literally saying, in nice words, that unless Congress gets their act together, America will go down a path by which recovery will not be seen for years. If we do not make good on our debt, expect catastrophic effects that will make 2008 Great Recession look like a field trip to Magic Kingdom, and no, I am not using hyperbole. A default on our debt will quite literally sink the stock market. The amount of chaos we will see will be a thing of once in a lifetime event, something your children and grandchildren will study in history class for sure. In fact, did you guys know that because of the current state of the economy, America's credit rating could get downgraded even if a default is avoided? That's right. America's perfect credit rating from Fitch and Moody's is literally being questioned right now, because there is a real chance that, based on the fundamentals as they read them, America's AAA rating is based on their preeminent states in the financial world. They are now warning that repeated episodes like the ongoing debate over raising the $31.4 trillion debt ceiling is chipping away at the current rating as they perceive it. The closer the United States gets to the expiration date when they run out of money, the more investors are forced to confront the unthinkable, a disastrous debt default. If Congress does not address the debt ceiling immediately, the United States will default on their obligations this summer. And even still, with all these institutions and experts and warnings from every knowledgeable economist, many market investors remain unworried. Ignorance is truly bliss in this world. I sometimes admire it from afar because it takes balls of steel and single-digit IQs to remain this solvent. The most common excuse I hear is that the odds, historically speaking, are on their favor, and that is a true point. However, experts have now begun to warn that the odds of the US defaulting on their debt has already tripled this year. The implied probability of a US default hit 11.3% as of February 24, which was up from just 3.3% at the start of the year 2023 when I actually began making videos on this topic. And so, with all this information relayed to you, I will not ask you to share my own thoughts on the economy, but to ask yourself this question. After all I shared with you guys today, do you feel confident in the American financial sector? Do you truly feel safe with your bank? Do you see American economy as improving or making steady progress? Does this perception of the economy strengthen your comfort in the current financial system and institutions you use? People tell me I am overly bearish. They have been telling me this since 2021 to be honest. But here we are, months later after that fake pump by the stock market, with banks literally flipping up by the day, billions of dollars in losses, tens if not hundreds already of millions of Americans struggling to keep the lights on in a rooftop over their heads, with mounting delinquencies reaching levels not even seen in the last Great Recession of 2009. I am bearish on this market, and I will stand by that conclusion until I begin to see the real improvements with significant progress on various parts of the economy, especially inflation. I do not impose this view onto you guys, but just please keep in mind all the information relayed to you, for they are not baseless opinions, but tangible facts that can be researched and validated. Thank you for your time. I know this video was late and long, but I needed to make sure to watch as things developed in order to make a video that satisfied all the quality expectations I hold myself accountable to. Let me know what you guys think in the bottom. Come join the Discord if you are looking to make money day trading options or just selling puts and calls on the weekly with little input and risk from you. I will hope to see you on the next video, and until then, to the moon.